Hey everyone, welcome back. Today we're going to get into startup valuations, but we're putting on our explorer hats and heading down south. You ready to talk Latin America?
Always ready to dive into an exciting market.
It's a region that's always buzzing, right? And we've got some exciting research to unpack today from Astella, the VC firm. They're really shaking things up, challenging how we think about early stage valuations, especially in these emerging markets.
And they've come up with this interesting new tool, the V Multiple, to try to get a clearer picture.
Yeah, the V Multiple. By the end of this deep dive, you'll know exactly how it works and, more importantly, how you can use it to maybe uncover some hidden gems in the Latin American startup scene. Kind of like having a superpower, right?
I like that analogy.
Now, anyone who's spent any time in the VC world knows the saying, entry price doesn't matter. It's all about finding that one company that goes 100x, right? The unicorn.
Right. The idea being if you miss that one, it outweighs all the other smaller wins. But, well, the reality is a little different, especially in Latin America. Over the past, say, 2 decades, there's only been one exit over $10 billion. Just one.
So banking on that one unicorn, it's a bit of a gamble, wouldn't you say?
It's a high-stakes game for sure.
And there's one thing you can control as an investor, unlike product development or building the team, that entry price.
It's true. You can't predict everything, but you can at least decide how much you're willing to pay to play.
Exactly. And this is even more important now with seed round valuations in places like Brazil getting closer and closer to U.S. valuations. They've actually quadrupled since 2017. At least that's what Spectra is reporting.
Which just highlights the need for a more precise way to figure out what these companies are actually worth. And this is especially true when you're talking about early stage companies.
Because those traditional metrics, like the rule of 40, don't always cut it for companies that are still in those early stages, right?
Rule of 40, right.
Okay.
So for those who might not be familiar, it basically suggests that a software company's revenue growth rate combined with its profit margin, that should at least be 40%. But that might not be the right way to look at it for a startup that's focused more on rapid growth and not necessarily immediate profitability.
Makes sense.
That's where this V multiple comes in. It's really designed for those early stage companies, where maybe those traditional metrics don't tell the whole story.
So let's break it down then. The V multiple, it uses 3 main things: post-money valuation, gross margin, and then the annualized growth rate. Did I get that right?
You got it. You can think of post-money valuation kind of like enterprise value, especially for these startups that aren't exactly swimming in cash. And then looking at the annualized growth rate, specifically over the past 6 months, that really captures the rapid-fire changes happening in those early stages.
It's like a real-time snapshot instead of a yearly view, which could be outdated before the ink is dry.
Exactly. And here's where it gets really interesting. The V multiple formula actually gives double the weight to the growth rate compared to the gross margin.
Okay, now that's interesting because everyone's obsessed with companies being like lean and profitable, right? From day one. So why emphasize growth so much in this model?
Because ultimately it's growth that really drives the markets. There was this study by Guggenheim in 2022 that found that even when everyone was hyper-focused on efficiency, the market still rewarded growth twice as much. The V multiple, it's not just some made-up formula, it's rooted in how investors actually behave.
I like it. It's based on reality.
And because it takes both growth and margin into account, it lets you compare apples to apples, or in our case, maybe one Latin American startup to another, more effectively. For example, you could have 2 companies with the exact same revenue multiple on paper, but their V multiples could be wildly different depending on how fast they're growing and their margins.
Okay, I need an example. Give me an example. Let's say I've got a company with a 20x revenue multiple.
Yeah.
How would different growth rates and margins change their V multiple?
Let's say this company has a 60% gross margin. That's basically how much revenue they keep after they cover the cost of making their product or service. If they are growing at a rate of 50% annually, their V multiple would be 3.75x. But if that growth rate doubles to 100% annually with the same margin, suddenly their V multiple jumps to 7.5x.
Whoa, so just by growing faster, even with the same revenue multiple, their V multiple doubles. That really highlights how much growth matters in this calculation.
It's a key driver for sure. Now let's say we have another company, also with that 20x revenue multiple, but this one's only growing at 25% annually. Even if they have a fantastic 80% gross margin, their V multiple would only be 3x.
It really does make you think differently about those companies that might be overlooked if you're just looking at traditional metrics, Like you're finding the hidden potential.
It's like finding a diamond in the rough. And this is especially important in a market like Latin America, where those valuations haven't historically been as high as their counterparts in, say, the US.
Which leads to the question, is there like an ideal V multiple that investors should be aiming for?
Oh, if only it were that simple. There's no magic number, unfortunately. It really depends on the industry, the company's stage, what the market conditions are like overall. But a good place to start is to look at publicly traded companies in the same region.
Yeah, it's like checking the price tags at other shops to get a sense of what things are going for. So what does that look like for Latin American tech companies?
Well, as of August 2024, the median V multiple for those bigger players in the region, it's sitting at 4.5x.
Which is interesting because even with all this impressive growth we're seeing from Latin American startups, their revenue multiples, they're rarely above 10x, right?
Rarely.
Yeah.
And when you compare that to something like the Cloud Index, which is mostly US-based companies, the difference is pretty stark.
Yeah, those companies are often valued well above 10x revenue,
Right.
sometimes even 20x or more, right?
That's right.
So why? Why are Latin American companies, even those with solid growth and good numbers, why are they valued at a discount compared to their U.S. counterparts? Is it just a matter of perception catching up, like maybe investors haven't quite grasped the potential yet? Or is there something else going on?
That's the million-dollar question, and it's one we're going to dig into today.
This is where it gets good. I'm ready. So we've got this gap, right, between the potential we see bubbling up in Latin America and how the market's actually valuing these companies. It's like finding a hidden treasure chest, but nobody's figured out how to open it yet.
It's a bit of a head-scratcher, right?
It is. So why do you think that discount exists?
Well, I think there's definitely an element of perception at play here.
Perception, how so?
Well, investors, they tend to add a bit of a risk premium when they're looking at emerging markets.
Yeah,
It comes with the territory, concerns about political instability, economic swings, currency fluctuations, you name it.
yeah, those are all valid concerns.
Right.
But the V multiple, it already kind of accounts for some of that by comparing companies within the same region, right?
That's the beauty of it. It levels the playing field within Latin America.
Okay, so if it's not just those broad market risks, what else is contributing to this undervaluation?
One word.
Liquidity. Liquidity. You mean like how easy it is to buy and sell shares in a company?
Exactly. You see, in the US, you've got this massive pool of investors, both big institutions and regular folks, who are constantly buying and selling stocks. Creates this like well-oiled machine of liquidity. And generally speaking, more liquidity means higher valuations.
Makes sense.
Now, in Latin America, the pool of investors is smaller, and as a result, there just isn't as much trading activity, so exiting an investment can be trickier, which some investors might see as a risk.
Right, because if they're not sure how easily they can cash out, they're not going to want to pay top dollar up front, even if the company itself is doing great.
You hit the nail on the head. It all comes down to risk and perceived value. And then, of course, there's the issue of market size.
Right, because while Latin America's population is significant, it's still dwarfed by the U.S. or Asia for that matter. So does that smaller market size make it harder for those startups to achieve the kind of scale that gets investors really excited?
That's a key factor. Think about it. Many U.S. tech companies, they're thinking globally from day one. Latin American startups, on the other hand, they often focus on their domestic markets first, which, as we've said, can be smaller. So it might take longer for them to hit those revenue numbers that really make valuations skyrocket.
So even if you've got this amazing tech, a brilliant team, a solid business model, those external factors like a smaller market size, less liquidity, they could still create a drag on the valuation.
It's the classic battle between perception and reality. And this, my friend, is where a tool like the V multiple really proves its worth, because it lets us cut through all the noise and look at those company fundamentals, potentially uncovering some real hidden gems along the way.
It's like having that special lens, right? That X-ray vision.
Exactly. And here's where it gets even more fascinating. This whole undervaluation thing, it doesn't just apply to companies that are just starting out. We're seeing it with established Latin American tech companies that are publicly traded, companies that have a proven track record.
You mean companies that are already generating serious revenue?
Big time.
They're still facing this discount.
Sadly, yes. Take Mercado Libre, for example. They're often called the Amazon of Latin America, right? Huge player in e-commerce and fintech, massive customer base, consistently strong financials, and yet even Mercado Libre has historically traded at a lower revenue multiple compared to their U.S. counterparts like Amazon or Shopify.
It's like even when you reach that level of success that most startups can only dream of, those external factors can still linger.
It really highlights the fact that this is not just a temporary thing. This isn't just a matter of the market catching up. There are deeper forces at work, which is why it's so vital for investors to understand not just the numbers, but the broader context when they're sizing up companies in Latin America.
So it's not enough to just look at the financials. You really have to understand the market, the regulations, even the cultural nuances that might be influencing those valuations.
All of it, connecting those dots, seeing the bigger picture, that's what separates those who are just riding the wave from those who are truly in the know.
And for those who are willing to do their homework, to dig a little deeper, that's where the real opportunities are.
100%. You can find some incredible companies with massive potential that are being undervalued simply because people aren't looking at them through the right lens.
It's all about asking the right questions. But even with a tool as insightful as the V Multiple, we can't forget that valuations are only one piece of the puzzle. There's more to a company's story than just numbers.
Right. You're absolutely right. There are other crucial aspects to consider, like a company's competitive advantage, for example.
Like having a moat, right?
Yeah.
Around their business that makes it tough for others to just come in and copy them.
Exactly. That competitive advantage, it could be anything from proprietary tech, some unique IP they've developed, or even a really strong brand. Even that network effect, where the more people use it, the more valuable it becomes.
Like how everyone ends up on that one social media platform where all their friends are already hanging out.
Exactly. And these are all things that can make a company more valuable, even if the financials haven't fully caught up yet.
Reminds me of that Morgan Housel quote. Every market valuation is a number from today multiplied by a story about tomorrow.
Love that quote. A good story can definitely boost those valuations, but at the end of the day, it's the execution, the actual results that matter.
Because you can have a fantastic pitch deck, but you need to back it up with real growth, a clear path to profitability.
100%. Investors need to look beyond the hype and really dig into the fundamentals. Can this company actually deliver on their promises?
It's like being a detective, right?
Yeah.
Piecing together the financials, the market dynamics, the team, the competition, trying to get the full picture.
Exactly. It's all connected. And you got to be willing to challenge those assumptions, especially in a market as dynamic and full of potential as Latin America.
Because sometimes the best opportunities, they're found off the beaten path.
Absolutely. That's where curiosity and a bit of adventurous spirit can really pay off.
So as we wrap things up here, what's the key takeaway? What should our listeners be thinking about as they maybe explore investment opportunities in Latin America?
I think the big lesson here is that valuation, it's not a one-size-fits-all kind of thing. The V multiple, it's an incredibly useful tool, no doubt, especially when you're looking at those early stage companies. But you got to consider the whole picture, understand the market, the regulations, the competitive landscape, and don't be afraid to challenge those old narratives about emerging markets.
What we're seeing in Latin America, it's a region just exploding with innovation. Entrepreneurs tackling huge problems, building really exciting companies. And for investors who are willing to take that closer look, there's a real chance to get in early on something big.
I completely agree. Latin America might not have the same level of market liquidity or investor frenzy as some more established markets, but that also means there's more room for those in the know to uncover some real hidden gems.
It all comes down to asking the right questions, doing your homework, and trusting your gut.
Exactly. And remember, the most successful investors are often those who are willing to go against the grain to see the value where others might not.
Love that. Great advice to end on. Always stay curious, stay informed, and never stop exploring. Thanks for joining us for this deep dive into the world of startup valuations in Latin America. Until next time.